today's class, and today we are going to now start preparing financial statements. In short, we are done with the basic foundation topics in accounting. So today we are going to prepare financial statements of a company, and in this particular topic, you will have to recall all adjustments that we did in our previous classes. So I hope you are ready. And I know you are supposed to have a class yesterday, but I can see Waina has been taking most of those classes, but don't worry. Maybe next week I can try to have my 2 classes back. So financial statements of a company. Before we prepare the financial statements, we need to discuss some concepts revolving around a company. And to begin with, how do we define a company? What's a company? We normally say a company is an artificial person, meaning that a company has a right to sue, a company can be sued, a company can enter into a contract, okay, just like a natural person. Human beings are natural person. You can sue a fellow human being, okay? But for a company, it has these characteristics of a natural person, but it does not have life. And that's the reason why we are saying a company is an artificial person. In Kenya, we have the provisions of the Companies Account, and that is the Companies Act, Cap 486, that provides the various regulation or laws that are required during the formation of a company. And the people who come up with an idea of forming a company, we call them promoters. Promoters are the people who come up with an idea of forming a company. And the provisions of the Companies Act, Cap 486, demands that the promoters must consolidate 4 major documents for them to form a company. And these documents, number 1, are what we call the Memorandum of Association, that tries to regulate or show the relationship between the company and the users or the outsiders. And the Memorandum of Association contains several clauses, such as the name clause, the objective clause, the capital clause, situation clause. These are things that you are going to cover in your next level, intermediate level, under company's law. The other document is an article of association that defines the internal affairs of that company. For example, the method of calling meetings, how do companies vote. The internal affairs of that company will be contained in that document called the Article of Association. We also have the list of directors. The promoters must come up before submitting the documents to the registrar of company. The promoters must list all the directors of the company together with their details. That is their name, their telephone number, their email, okay, where they live. All these details must be contained under a list of directors. And then lastly, the declaration from the directors. The directors must declare that actually they are the directors of that company and they are mandated to perform certain duties or responsibilities. Okay. So upon consolidating all these documents, the promoters are required to submit these documents to the registrar of company, and the registrar of company is going to go through the documents, and once he or she is satisfied, is going to register the company and publish that in the Kenyan Gazette, that is in the context of our republic, that is Kenya. Okay, but generally, when you form a company, you are forming a company with an objective of executing certain mandates in order to make some revenue, and the end goal is to make profit in order to pay members or the owners of the company a return in form of profits, a return in form of dividends. Okay, so what we are saying is, when you form a company, when you want now to buy the assets, because a company cannot operate without assets, you have two major ways of raising capital to buy assets. That is either through floating shares or acquiring a loan facility. And remember, in our first topic, the accounting equation, assets is equals to capital plus liability. So the capital component is what we are calling equity. You are inviting the members of the public to subscribe for the company shares. And anyone who buys shares in return will give the company money. Okay. And then the company will invest this money in buying assets. These assets will generate revenue for the company, and the management of this company would again pay the people who bought shares, whether preference or ordinary, okay, a return in form of dividend. Okay, if you decide to um, finance the assets through acquiring a loan, what we call debt, which again will be a liability to the company, at the end of an accounting period, after the assets have generated revenue, the people who gave the company loan, the creditors of the company, will expect the company to give them interest and the principal amount that loan. Okay, so when you form a company, the assets can be financed either through the equity component or debt component. Let us begin with the equity component. When you buy a share, assuming you are a shareholder, you can either buy ordinary share or preference shares. Okay, ordinary shares are also called residual shares. They're also called common shares. When you buy these shares, you will be entitled to voting rights in a company. The people who buy ordinary shares, they are actually the owners of a company. So in case of a major decision, they will be entitled to vote. But now the limitation is, when sharing dividends, when a company has declared dividends, the company will always pay first the creditors, then the preference shareholders, and then ordinary shareholders will always be paid last. Okay, because they are the owners of the company. If you invite a visitor at home and you are serving food, you are going to serve the visitor first, then your children, and then you last. In case the food is not enough, you will forego. Okay, now that is the same case when it comes to company. Ordinary shareholders are paid last. And I want you to notice that when it comes to dividend, their dividends does not have a fixed rate. Okay, and that's why they are called residual shareholders. They normally share what is left, okay, in proportion of the shares held. But for preference shareholders, from the word prefer, they are paid first before ordinary shareholders. You can see again their dividend is fixed. For preference shareholders, their dividend is fixed. But the limitation of preference shareholders is that they do not have a voting right. Okay, they do not have a voting right, and therefore they do not have control over the major decisions made in a company. So those are the two major types of shares. But I want you to note that under preference shares, under preference shareholders, we have also other types of or categories of shares under preference shareholders. For example, number one, preference shareholders can be convertible or non-convertible. So what do we mean by the word convertible and non-convertible? So from the word convertible, these are shares that you can be able, actually, they have some type of right. If you are the holder, you can actually convert them to ordinary shares. Okay, so they have some clauses that allows you as the holder to convert these shares to equity. Non-convertible, they do not have that right or the option to the holder to convert them to ordinary shares. We have redeemable and irredeemable. So redeemable, the word redeemable means you can be able to buy them back. Okay, irredeemable means you cannot be able to buy them back. The company does not have the right to buy them back because there's a clause that limit the companies from buying those shares back from the shareholder. But redeemable, they have a clause that allows the company to redeem or to buy back the shares. We have what we call participating and non-participating. From the word participating, okay, they have an additional benefit. Remember, when a company declares dividends, or let me give an example, when a company is being wounded up, creditors will be paid first, then preference shareholders, then ordinary shareholders. So if you have participatory shares, it means whatever is left, you can participate. Okay, you can participate together with the ordinary shareholders. But non-participating or non-participatory preference shareholders, they cannot be able to participate either in form of the dividends that has remained, or in case of a company has been wounded up, whatever has remained, they cannot be able to participate, okay, in sharing. Then we have cumulative and non-cumulative. So remember, a company can decide not to declare dividends during a particular accounting period. So if they do not declare, remember preference shareholders, they have a fixed rate of dividend. So if a company decide not to declare dividends, if you are a non-cumulative preference shareholder, it means you cannot be able to carry forward your dividends. Okay, so you are going to lose everything because you don't have the right, your shares do not have the right to carry them forward to the next accounting period. But if you are a cumulative preference shareholder, it means you have the right to carry forward. Even if the company did not declare dividends, you still can be able to carry forward your dividends and be paid in the next accounting period. Okay. Then lastly, we have what we call shares with callable option. These are shares whereby the shareholder has the right to redeem the preference shares in between. Okay, so you can redeem them at a premium, okay, if it was redeemed in between. Okay, so this is like an option. We normally have what we call call option. We also have what we call put option. Okay, so the rate of that preference dividend will be dictated by the prevailing prices in the market. So those are the types of preference shares. But you can be asked in an exam, discuss types of share capital. What we've discussed is types of shares. Types of shares. But in an exam, you can be asked to discuss types of share capital. So what do we mean by share capital? During the formation of a company, the promoters or the people who come up with an idea of forming a company, they need to declare to the registrar of company, okay, the total number of shares that the company intends to issue to the members of the public in order, okay, to know their total share capital, what we call authorized share capital. So in their document under the capital clause in the memorandum of association, the promoters must indicate the authorized share capital. Authorized share capital means if the authorized share capital is 50 million, it means that company cannot do any work that exceed 50 million. They can do any work from 50 million and below. That is authorized share capital. So it means therefore authorized share capital, or what we call registered or nominal capital, is the total share capital that the company is allowed to issue to the members of the public or shareholders. Okay? And if the authorized share capital is 50 million, you cannot raise from the members of the public, okay, amounts more than 50 million. Are you together? You cannot exceed or you cannot issue more shares, okay, exceeding the authorized share capital. You cannot do work. For example, if you have applied for a tender, you cannot apply for a tender that is worth more than 50 million. It's going to limit your scope. Are you together? Then you have what we call issued share capital. Now, out of the authorized share capital, out of the authorized share capital, you may decide, maybe the authorized share capital of a company is, let's say, 50 million. You decided to issue 40 million shares. So we are going to say the issued share capital in our case was or is 40 million. It is the shares that the company decides to issue to the shareholder. And that should, the issued share capital should always be less or equal to authorized share capital. You cannot issue shares that are more than authorized share capital. It is either equal to authorized or less. Are you together? Up to that point? Now, called up share capital. So, if a company has issued a share, let's say the par value of a unit of share is 10 shillings. Maybe upon issuing that share, the shareholder paid 8 shillings. So there is a remaining 20 shillings that the shareholder has not paid. So when the company, okay, calls the shareholder to make the additional amount, okay, the additional capital required, we are going to say that 2 shillings multiplied by the number of shares that the shareholder had acquired will form what we called up share capital. Okay, that 20%, 2 shillings of 10 shillings is 20%. Are you together up to that point? Are you together?
Yes, yes.
Now, uncalled share capital is the opposite. Okay, this is the share capital which the company has not requested for payment. Okay, and therefore these amounts may be received in the future period. But called up share capital, it has already been called by the company, okay, as an additional capital. But uncalled share capital, the company has not yet made request for payment from the shareholder. Okay. And then paid up share capital now is what the shareholder has paid. Whatever the shareholder has paid in total is what we call paid up share capital. Okay. So this is what I had explained, the distinction between preference shares and ordinary shares. You can get this in theory, okay, in your paper. So we've said preference shareholders, they don't have ownership right. Ordinary shareholder, they have ownership right. Preference shares, they do not have voting right. Ordinary shares, they have voting right. And therefore that means that preference shares, they are not risky because you are not going to be involved with major decisions of a company. But ordinary shares, then because of these responsibilities, they tend to be riskier. Then preference shareholders, again we said they are paid first, they are preferred first, okay, but for ordinary shareholders they are paid last. And for preference shareholders, they have a fixed rate of dividend, but ordinary shareholders, they do not have a fixed rate of dividend. And therefore, for ordinary shares, if you acquire ordinary shares, that will be pure equity, okay, because there is ownership right, there is voting right. For quasi equity, that one is linked to preference shares because they do not have ownership right nor voting right. So it is important to remember at least 4 or 3 because you can get that in the question. Now we've dwelt on the equity component. When you form a company, one way of financing your assets is through floating shares, okay, but you also have the debt component. You can issue debentures. Debentures are loans from the public. So you finance your assets through acquiring a loan facility. So what is the distinction between shares and debentures? What is the difference? Because for a loan, we all know that the company will be required to be making interest payment every year. That is one. In terms of payment, creditors will always be paid first. For shareholders, they will always be paid last. Something else about interest. You need to know what is the rate of interest, meaning there is a fixed rate of interest. But for shareholders, in particular to ordinary shares, we don't have a fixed rate of return. It is only preference shares that we know there is a fixed rate of return. For debentures, again, they do not have ownership right. They do not have voting right. Oh, yeah, it is. I didn't go. They do not have voting right. But I want to bring to your attention, and this we are going to do later in your intermediate level. Under debentures, you can have convertible loans. Have you ever heard of convertible loans? These are loans that they have some clauses that enables the holder to convert the loan into equity. Meaning, if you are a creditor of a company, but there's a clause, okay, in the loan, convertible loan, that allows you to convert your loan into shares. So you can transit from being a creditor of a company to the owner or a part of ownership. Okay, so that is in the case of a convertible loan. Are you together? So again, you need to know the distinction between shares and debentures. A share is usually a unit of capital, capital, but for a debenture, it is usually a unit of loan. So again, you need to know at least 4. Are you together? Up together, up to that point.
Yes.
Now, because now you understand uh, the distinction between the equity component and debt component, the equity component has various elements. So what are the elements? Let me just add that here before we do a question. Elements of equity component. Number one, of course, is the ordinary share capital. Okay. Number 2, we have what we call share premium. So what is the difference between par value or market value and premium? Normally, during the formation of a company, the promoters, the people who come up with an idea of forming a company, they will always find a way of valuing, okay, the shares of that company. For example, they may employ various valuation techniques and conclude that a share is going to be valued at 10 shillings. But when they issue the shares to the members of the public, the equilibrium price will be determined by the forces of demand and supply, or what we call market price. So the market price may be 15 shillings, but the par value was 10 shillings. So that difference between the market price and the par value is what we call premium. So let me write it here. The difference between market price and par value. That's what we call premium. Ordinary shares, the way they are recorded in the financial statements, we record them at par, or what we sometimes we refer to as face value, or sometimes we call this intrinsic value. Then number 3, we have what we call retained earnings. Before retaining earnings, I could have maybe talked about preference shares capital, and then now lastly we have retained earnings, among others. So these are some of the elements that you expect to record under equity component when preparing financial statements. Okay, so I think we can do an illustration from the past paper. Let us go to April 2023. April 2023, question number 4. So allow me to share my screen. Someone to volunteer and read the question. This is April 2023, question number 4. Anyone to volunteer kindly? Yes. A volunteer. Anyone? Edith?
Question 4.
Yes.
The following trial balance was extracted from the books of Bahati Limited as at 31st March 2023. Ordinary share capital.
Go to addition information.
Okay. Addition 1. The company maintains a gross profit margin of 20%. As at 31st March 2023, account receivable balance included 250,000 due from a customer who has been declared bankrupt. The allowance for doubtful debts is to be adjusted to 5% of the account receivable as at 31st March 2023. As at 31st March 2023, administrative expenses accrued amounted to 175,000, while prepaid selling and distribution expenses amounted to 75,000. The company paid interest on the debentures for the year ended 31st March 2023 on 5th April 2023. Depreciation is to be provided as follows: building 2% per annum on cost, fixtures and fittings 10% per annum on reducing balance. The Capital's directors proposed that the preference dividend be paid, a dividend of 10% on ordinary shares to be paid, 2.5 2.5 M be transferred to general reserves. So you required the value of inventory, statement of profit, and statement of financial position.
Thank you. So I want us to do this question. The question carries a total of 20 marks. So it is important for you to pay attention. Now we have a trial balance, and you can see the trial balance total is okay because the debit side equals the credit side, 165,800, 165,800. Now we are interested with addition information, what we used to call adjustment in our previous topics. We begin with the addition information number 1. They are saying that the company maintains a gross profit margin of 20%. That information needs to remind you that when you come across the word gross profit margin, margin goes with sales. If it was markup, markup goes with cost of sales. So we have a gross profit margin of 20%, meaning if you want to know our gross profit, you simply take 20% of total sales. So maybe you can let us begin with the addition information number 1. So it was which sitting? 2022 December or April? August?
2023 April.
2023 April. Question 4. Yes. So working 1 or addition information 1, I want us to compute what we call the gross profit margin. So we've been told that it is 20%. 20%. So we ask ourselves, what is our, so this one is the rate. So that is our rate. And then we ask ourselves, what is the value for sales? So if you go back to the question, we need to find the sales. So the sales is here. The sales is, this value is, and remember the figures are in thousand. So this is 120,000, right? 120,000. So our sales there is 120,000. So to get gross profit, simply going to take 20%, we multiply that by 120,000, and we get what? 24,000. So 20% of 120,000 is 24,000. That figure will be useful when preparing the income statement, what they are recording profit and loss statement. Why? Because you can see here, normally in the income statement structure, we normally start with sales less cost of sales. Under cost of sales, we normally have opening inventory, we add purchases, we add carriage inwards if they are there, you less return outwards, then you less closing inventory. But you can see we have opening inventory in our trial balance, 1st April 2022. That is the beginning of our accounting period. But we do not have closing inventory in our addition information. So it means we are going to work backward. Because we have gross profit, we can work backward and get the closing inventory. And that's why the requirement A is you determine the value of inventory as at 31st March 2023. That means closing inventory, and that will give you 2 marks. So we are done with addition information number 1. The next chapter will be to prepare the income statement. Are you together? So we are done with that. We proceed to addition information number 2. As at 31st March 2023, account receivable balance included 250,000 due from a customer who has been declared bankrupt. So when a customer has been declared bankrupt, we call that bad debts. And for bad debts, we are required to write it off because it cannot be recovered. Okay. So because they had included this to 50,000 in the account receivable, we need to open the account receivable account and deduct the bad debts written off. But again, you have also to remember that bad debts written off is going to be an expense to the company. So we are also going to recognize that in the income statement as an expense. So let us open account receivable. So working 2, we are going to open receivables account or account receivable. So we open this account. So account receivables or debtors, it's an asset, so the balance brought down will be on the debit side, and that is the figure in the trial balance. So you go to your trial balance. Let us get the account receivable. The account receivable value is, you check the debit side because it's an asset. So 8250. I want you to confirm with me. I hope it is 8250. So we record 8250. So bad debts written off. That's how we write it. Bad debts written off. We need to eliminate that value. So in the addition information, the bad debt written off was 250. Remember the figures, our trial balance is in thousand. We need also to transform the addition information to thousand. So this one will be 250, not 250,000. So 250. So let us not close that account yet, but also remember also this bad debt written off will appear in the income statement as an expense. So income statement, we are going to take it later. So let us continue to addition information number 3. Let us not close that account because we may have provisions. Okay. So addition information number 3, allowance for doubtful debt is to be adjusted to 5% of the account receivables as at 31st March 2023. Now here we have allowance for doubtful debt. Let us go to the trial balance. Do we have allowance for doubtful debt? Yes, allowance for doubtful debt at the beginning of the year. And I want you to note that the figure appears on the credit side, 450. It is appearing on the credit side. Okay, because that allowance for doubtful debt is supposed to reduce the receivables value, and that's why it's appearing on the credit side. So let us open allowance for doubtful debt account. So allowance for doubtful debt account. So we open it. So, but remember, balance brought down figure is appearing on the credit side of the trial balance. So the figure is 450. So 450 there. Now we go to the addition information. The addition information, because we are doing adjustment on allowance for doubtful debt, we've been told it's to be adjusted to 5% of the account receivable as at 31st March 2023. For allowance for doubtful debt, I told you to check out two things. Was it adjusted, or are we supposed to adjust it at the end of the year or during the year? The statement here is as at. So meaning we are going to compute. So allow me to compute it here. Allowance for doubtful debt. Allowance for doubtful debt carried down at the end of the year. So we are going to say it was 5% of, we've been told, of account receivables. Account receivables was 82. The account receivable value in the trial balance was 8250. So this is the figure that we are supposed to record at the end here. That was the account receivable at the end. So the figure is 42 or 412. Yeah. So we can balance this account. That difference is either increase in allowance for doubtful debt or decrease. So if it's an increase, it will be an expense. If it's a decrease, you recognize it as income, other comprehensive income. So you can see at the beginning of the year, our allowance for doubtful debt was 450. It has reduced. So we are going to say here that decrease in allowance for doubtful debt. So that decrease. So it will be like an income. Okay. So we call this allowance for doubtful debt decrease. It's going to be simply 450 minus 412.5, so that now the account can balance. Up to that point, we are okay. So we can go back now to our account receivable account. Want to get what is the account receivable at the end of the year. So to get the account receivable at the end of the year, we need to add the accumulated allowance for doubtful debt. Accumulated allowance for doubtful debt at the end of the year, which was for 12.5. It was for 12.5. Remember, allowance for doubtful debt is supposed to reduce the account receivable. So at the end of the year, we had an accumulated allowance for doubtful debt of 412.5. So we need to eliminate it now for us to get balance carried down. So we get that. So the balancing figure will be, you can use your calculator, that plus that one. So our account receivable balance that we are going to take to the statement of financial position is 7587.5. So we are done with these two accounts, allowance for doubtful debt. And remember, The bad debt written off will appear in the income statement as an expense. The decrease, this one was a decrease, okay? Decrease in allowance for doubtful debt, decrease, will appear in the income statement as an income, okay? So we continue. Next is working for or adjustment for. So adjustment for, we have been told as at 31st March 2023, administrative expenses accrued amounted to 175. That's an accrued expense. You are supposed to add an accrued expense to the existing expense that was paid in cash. And then we have prepaid selling and distribution expense. So prepaid selling and distribution expense, because it does not relate to this year, you're supposed to eliminate it. You remember accruals and prepayments. So let us prepare the two accounts. Administrative expense account. So administrative expense account. So you can see, once you are good in adjustments, these things will be relatively easier. So remember, for expense and revenues, let me begin with expense. The value that you are going to extract from the trial balance for expenses, you label them in the T account as paid on the debit side. For revenue, of course, you are going to take them to the credit side of the T accounts and you label them receipts. Don't ever forget that. So administrative expense, go to that, this trial balance.
Come again, Mwalimu.
For expenses and revenue,
Mm-hmm.
we know very well that expenses will always appear on the debit side of the trial balance, right?
Yes.
So if an item appears on the debit side of the trial balance, it's going to appear again on the debit side of the ledger account or the T account.
Mm-hmm.
So for expenses, how do we label an item for an expense that we have extracted from the trial balance? You label them as paid, meaning they have already been paid for.
Okay.
So the narration will be paid for expenses. For revenue, because they are appearing on the credit side of the trial balance, you are going to take them to the credit side of the T account and you are going to label them receipts, because we are going to make an assumption that you have already received them because they are in the trial balance. Are you together?
Okay.
Yeah, so administrative expense, anyone is going to, yeah, here it is. I don't know whether it is 3650.
Yes.
3650. So we take this to the debit side, that's 650. Then we were told there was an accrual, meaning it was not paid for, but it relates to this period. The word accrual means it relates to this period, but you've not paid for it. Okay, so you are going to consolidate or aggregate it with what has already been paid for. Okay, so accrued expense or accrued administrative expense was 175. So we are going to record here 175, and then we balance that account. Balance that account. So the balancing figure will be called IS, because remember in our first topic we said for revenue and expenses the balancing figure is titled IS because you are going to record that value in the income statement. That is the balancing figure that you are going to take to the income statement. So we are done with that. So we open the other account, which is selling and distribution account. Selling and distribution account. So So again, you go to your trial balance, get the paid figure. So the paid figure here is selling and distribution is 41. This one 41.75. It is 41.75. But now go to the addition information. This was not an accrual. Addition information. Prepaid selling and distribution expense amounted to 75. This is 75. Remember, for consistency, 75. So prepaid meaning you have received it in advance. You have received it in advance. According to accrual concept, you are supposed to record an item in the period in which it relates. So for prepayment, we normally subtract it because that amount that we received in advance is already here. It's already in this figure 41.75. So we remove it for us to remain with only values that relates to this accounting period. Are you together? So prepayments, remember, we always remove them. Okay, every time you see prepayments, you record it the opposite side, so that now we remain with what you are going to take to the income statement, because the income statement is titled for the year ending, meaning anything that relates to that accounting period. So we are going to balance this account like that. Then we get our balancing figure, which is 4100. So we are done with working number 4. We move on to working number 5. The company paid interest on debenture for the year ended that 5 March 2023 on 5th April. Now, if you go to the trial balance, let us try and get the debentures. You know, there are two ways of financing assets. So there was also debenture for this company. 8% debenture. 8% debenture. 1, 2, 3, 4, 1, 2, 3, 4. This is 2,500. I hope it is 2,500. So 8% of 2,500 was paid. But the addition information says the company paid interest on debenture for the year ended at 1st March 2023 on 5th April. If you go to the accounting period, our accounting period runs from April to March 2023. So that interest was paid outside our accounting period. So what we are going to do, because we are not interested with items outside our accounting period, we are going to recognize that because it was incurred inside our accounting period but paid outside our accounting period, we are going to record it as an expense in the income statement because it relates to this period. But we are not going to record it as if it was paid for. We are going to recognize it in the statement of financial position as a liability. Why liability? Because inside our accounting period, that is 31st March 2023, okay, we don't have information on whether it was paid for. So it's going to be a liability between 2022 April to 2023 March. Are you together? So let us calculate that interest. It was debenture 8%, 8% debenture. So it is 8% debenture. So debenture working 5. Debenture. So it is 8%. 8% of 2,500. Was it 2,500?
2,500.
Yeah, so this one is the interest. The interest. So we've said this interest we are going to recognize in the income statement and statement of financial position as liability. Don't forget that, liability. Okay, as liability. Why liability? Because as per our accounting period, it has not been paid for. It was paid outside our accounting period. So we continue with working number 6. So far, so good with the adjustments. So number 6, Depreciation is to be provided as follows. Building 2% per annum on cost. Every time you come across the word on cost, just know that is straight line method. Okay. For reducing balance method, they have to tell you explicitly. And for this one, they have said fixtures and fittings 10% per annum on reducing balance. So let us compute depreciation. We are going to start with building. So depreciation. So working number 6 is about depreciation. So we start with building. Building. So the building is the rate is 2% on cost. 2% on cost. So what is the cost of the building? Remember, we are using cost, not net book value, but the cost. So the building cost is, this one is 22,500. 22,500. So this depreciation, you are going to recognize it in the income statement because it is depreciation during the year. Okay. But it is also important when you are computing these things for you not to do this adjustment twice. Simply get the net book value also, which is cost. Remember how we get the net book value: cost minus accumulated depreciation minus depreciation for the year. Okay. So to get the net book value, simply be cost. Our cost was 22,500. We subtract accumulated depreciation. It must be there somewhere. Yeah, here it is. It is for building, it is 6250. You can see it. I hope you can see it. 6250.
Yes.
Yes, 6250 minus depreciation for the year, which is
450.
450. So we get the net book value. So our net book value is 15,800. So let us do the other adjustment. So we have what we are going to take to the income statement as 450, the statement of financial position as 15,800.
15,800.
Yes. So let us move on to the other one, fixtures and fittings, and this one is reducing balance. Fixtures and fittings. So for fixtures and fittings, the rate is 10%. Remember how we compute reducing balance? You first of all subtract the accumulated depreciation from the cost. That is the difference. So we come to the trial balance. The cost of fixtures and fittings is 6,000. But you subtract accumulated depreciation first, which is 1,400. So you get 460. That one we're going to take to the income statement. Okay. For net book value, the formula remains the same. So net book value is going to be the cost, which was 6,000 minus accumulated depreciation, which was 1,400 minus our depreciation for the year, which is 460. So you get 4140. So this one we are going to take it to the statement of financial position. Yes. So we are done with that because we have what we are going to take to the income statement and what we are going to take to the statement of financial position. So we are in working number working number 7, the last one. So the company's director proposed that. Now, every time you see the word propose, and I want you to get this, Proposed, if it's a payment, something that the company was supposed to pay, it means they have not paid for it at the end of the year. So if it is proposed dividend, despite the fact that you are going to recognize it in the profit or loss statement, you are also going to recognize it in the statement of financial position as liability. Why? Because you've not paid for it. Are you together? So every time you see the word propose, they proposed to pay tax, they proposed to pay dividend. That tax and dividend will appear in the statement of financial position as liability. So let us begin with the first one. Preference, the company director proposed that preference dividend be paid, but we are going to assume it has not been paid. So what is the preference dividend? Come back here. The preference dividend is 10%. You see, remember preference dividend, they have a fixed rate. So it is 10% of the 2500. So let us compute. So working number 7. The first one is preference dividend, which is 10% of the 2500. You can see preference share capital was 2500. So 2500. That one. So we are done with that one. The other one was a dividend of 10% on ordinary shares be paid. A dividend of 10% on ordinary shares. So ordinary shares dividend. Ordinary shares dividend. So they have said 10%. So 10% of what? What is the total number of ordinary shares? Ordinary shares is 15. Here it is 15,000. So 15,000. So that is 1500. And then lastly, 2,500 to be transferred to general reserve. So that means for you to transfer anything, every time you come across company's account and they are asking you to transfer will always come from the profits of the company, retained earnings. So when you are told to transfer, it means you reduce the retained earnings and you increase the account that they want you to transfer these amounts to. So here they are telling us to transfer it to general reserve, meaning our general reserve is going to increase by 2,500, while the retained earnings account is going to be reduced by 2,500. So what we can do, we can open two accounts. One, of course, is the retained earnings account. Retained earning accounts, where the amount is being reduced. So you cannot transfer from ordinary shares. You only transfer amounts from the retained earnings, okay, because that's where the profits of the company are recorded. So that is the retained earnings. Let me record the other account here just beside it. It is called general reserves. General reserve account. So all these are equity components. So meaning balance brought down for all of them are on the credit side. Okay, these are equity or capital components. So let us begin with retained earnings. What is the retained earnings in the what trial balance? Retained earnings brought down at the beginning of the year. So it is 90/50. 90/50. 9050. What about general reserve? Because it must be there. For general reserve, you can help me to locate the general reserve. Do you see any general reserve, or it's not there? Yeah, it is not there. So we don't have balance brought down for general reserve, but we are going to transfer something to that account. So let us say it is 0. So when you transfer that from retained earnings, it means the retained earnings is going to reduce. So that transfer of 2500 is going to reduce in the retained earnings account. But in the general reserve, we are going to record it on the credit side because it is increasing that account. Okay. And that means we can close the general reserve account, but we cannot close the retained earnings account. Do you know why? Because we also need to record in the retained earnings account what is the retained earnings for the year, and that one you are going to get it after preparing the income statement. Okay, this one is brought down. We need to record retained earnings for the year. Let me just indicate it here for the year. And that one, we are going to get it after preparing what? The income statement. Preparing the income statement to get the profit for the year. So this one we are not going to balance, but for general reserve, we can go ahead and balance that account, 2500. Yes. So retained earnings, we are going to come back later to that account. So my friend, the only remaining thing here, because we are done with adjustment, is now to prepare the income statement. Now, don't worry about a value of inventory. That value, we are going to get it when preparing the statement of profit or loss for the year. So what was the name of this business? Now let us prepare now the statements. The name of this business is Bahati Limited. So Bahati Limited. This one is called statement of profit or loss account for the year ended 31st March 2023 or 2022. Let me check. 2023. Yes, so we are going to have columns in the values are in shillings, and like that. Let us center this. Center this. We also center this. So we are going to begin with sales, right? Start with sales. So if you go back to this trial balance, sales will always appear on the credit side of the trial balance. So sales is 120,000. Here it is. I hope you can be able to see that. It is 120,000. So we record 120,000. Then you ask yourself, do we have sales return or return inwards? Have you seen anything? Return inwards should be on the debit side. Check with me. Do we have return inwards or sales return? Should be on the debit side. So you check only the debit side for anything like return inwards. I can see we have return outward. We have return outward here of 2,000, but do we have return inwards? Do we? No. So we proceed with cost of sales. So here we are going to say less cost of sales. So for cost of sales, we always start with opening inventory. So what is the value for opening inventory? It It is there. Inventory as at 1st April, it is 10,
500.
500. So we record 10, 500. Then remember we always add what? Purchases. Purchases. Purchases is 105. Here it is. Debit side 105, 500. 105, 500. Then less what? Return outwards. Return outwards. So remember always to start with negative because we are supposed to less that. So return outward, it was somewhere, it was here, 2000. 2000. 2000. Then you can less again closing inventory, and we don't have closing inventory. That's what we are required to find, closing inventory. But even if you don't have closing inventory, we know when you get closing inventory and you add everything, you are supposed to get a figure there, and that figure is supposed to help you get gross profit. But we already have our gross profit. We have gross profit, so we can work backwards. So gross profit, we had computed it. It was working number 1. It was 24. Here it is. Here 24,000. Okay, it is 24,000. So it means if gross profit is 24,000, and how do we get gross profit? It is 120,000 or sales minus cost of sales. So the total that we could have gotten here, suppose we had closing inventory, was cost of sales. But we can be able to get this value, cost of sales, by taking 120,000 minus 24,000. Because now, if you take 120,000 minus this one, now 96,000, you get 24,000. So it means this is our cost of sales. But how do we get the closing inventory now? We know very well that when you add all this, supposed to give you this. Okay, when you add all this, supposed to give you this. So we can get that closing inventory by saying 96,000 minus, open bracket, you add all this. This plus this plus this. Yes. So our closing inventory is 18,000. Are we together up to that point? Up to that point, we are okay. So we've answered part A, that required us to compute closing inventory. Okay, and if you want to check, when you add this plus this plus this plus this, supposed to give you 96,000, and then 120,000 minus 96,000, it is 24,000. I hope we are together. Then now you come to other income. Other income always begin with the one you adjusted. We had decrease. I remember we had decrease in allowance for doubtful debt. You remember that decrease? Cha tuitafute huko juu. Decrease, we had decrease. Here it is, decrease. Here, decrease in allowance for doubtful debt. It was 37.5. The doubtful debt at the beginning was for 50, at the end was for 12.5. So this is like an advantage to the company. So that was a decrease. We recognize it there. Now, do we have any other income from the addition information before we go to the trial balance? Any other form of income? I don't think so. So you can go to the trial balance. Check the credit side. Incomes are usually recorded on the credit side. So you check the credit side. We have discount received. You can see here. This discount received of 325. So discount received, it will be form of income. Discount received, and it is, how much is it? 325. Help me to check any other income. Don't have any other, right? Don't have any other. Discount received only. I can't see any other. So therefore we can get that total, which is gross profit plus that plus that. Now let us record expenses. For expenses, I know we had so many expenses that we adjusted, such as selling and distribution. Remember selling and distribution? So we begin with selling and distribution. So selling and distribution, where is it? Oh, I've started with selling and distribution instead of admin. Okay, it's okay. I'm going to record admin next. So selling and distribution is 4100 IS. Then next, administrative expenses. So we record admin. Admin, here it is. Then we had depreciation. We had depreciation for two items. The first item was what? You can remember. We had depreciation for, it was building and fixtures and fittings. So we start with building. And the depreciation we are taking here is the depreciation for the year. So depreciation for the year. Here it is, building. Next is for furniture and fixtures. Yes. So go to the account. Here it is, 460. What else did we have? Bad debts. Remember bad debts written off?
Yeah.
Bad debts written off. So bad debts written off. Where did we record it? Bad debts written off. We recorded it somewhere. Here it is, 250. Then we also have interest. Remember debenture interest? Debenture interest. There was a working on debenture interest. So debenture interest. Here it is. Debenture interest of 200. Anything else from the workings here? Anything else we've not recorded? I think we've recorded everything. Now let us go to the trial balance on the debit side. Anything that's an expense that we've not recorded, like for example discount allowed, you can see here we have discount allowed of 125. Discount allowed of 125. 125. And then we have director's fee. You can see we have director's fee here of 1000. Director's fee 1000. Anything that we did not adjust, you just record them the way they are. Anything else? Selling bad debts written off. Wait a minute, we had bad debts written off of 100, and in the okay, so this one, bad debts written off, this one, we have two bad debts. We are supposed to open a separate bad debts written off so that we can consolidate the 100 together with what was there in the addition information. So for this 100, it's just a matter of adding it to whatever is there. So this bad debt, we are going to add 100 for now for it to be 350. Okay, are you together? Yes, but that 100, you are going to notice we did not adjust it in the T account, receivable account. Why? Because it's already been adjusted for. If two items appear in the trial balance together, it means they have already adjusted for that figure. We only adjust for what is in the addition information. Are you together? What's appearing in the addition information, because that is what requires adjustment. So anything else we've not recorded? So let us continue. The balance sheet is going to tell us because it must balance. So we are going to add all of these expenses to get what we call profit before tax. So profit before tax is simply you take your total revenue, you subtract your total expense. Okay, so that is our profit before tax. In this question, did they tell us the tax figure? Was there a tax, or they assumed we are not taxing this company? Yeah, we don't have information for tax, so we are going to assume tax is 0. Then we get profit after tax, which again is going to be the same figure anyway, but we are following the way these accounts are supposed to be opened. It is that one minus 0. Then next you pay dividends, so less dividends. So you pay dividends. So the dividends that were proposed here, we had the first one, preference dividend. So preference dividend of how much? The preference dividend, preference here it is 250. Okay, so you're supposed to less, and then we have ordinary, which is that. So we can add negative sign here because we are supposed to less. So we get what we call now retained earnings for the year. So retained earnings for the year will be that one plus these negatives values, that 12,102.5. You remember our retained earnings account? We said in that account, for us to balance, we are supposed to add the retained earnings for the year. So we already have our retained earnings for the year, which is 12,102.5. So we add that there, 12,102.5, and we can go ahead and now balance this account before preparing the statement of financial position. So our balance carried down that we are going to take to the statement of financial position will be this minus that. So we get 18,653. Did I leave the decimal here? Wait just a minute, this one. I want it to be in decimal the way it was. Yes, like that. Yeah. We continue. Now let us prepare the statement of financial position. That statement will tell us whether we've been doing the right thing because it must balance. So statement of financial position, statement of financial position has that normally say has that. So we are going to have here shillings. Of course, the figures are in thousand. So going to have another one here. We start with non-current assets. So our non-current assets were, we had building, I remember. Now you record the net book value. We had building. The building value, it is somewhere. Building. Yeah, we had building. Net book value is 15,800. Then we have furniture and fixtures. The value is somewhere there. Here it is 41,40. Let us go to the statement of our trial balance to check. Now we are looking at the debit side. Anything that we've not recorded, account receivable, we are going to record it later. Purchases, we are done with that. Building done. Fixtures done. We are done with non-current asset. No, the last item, investment at fair value. That's an asset. Investment at fair value, 4,000. So investment, we have investment at fair value for 4,000. So at least we are done with non-current assets. We move on to current assets. So current assets, we have inventory. Remember, inventory that we are going to use here is closing inventory, the one we've computed. The one we've computed in the closing inventory here. This one, 18,000. But you're not supposed to record it as a negative, so we are going to add another negative here to make it positive. So it is 18,000 closing inventory. We have closing inventory there. Then next we can record receivables. Now this is supposed to be in this column. So receivables. We had our receivable account. Here it is, balance carried down there. Then remember we had prepayment. When you make payment in advance, it means that is an asset for you. So the prepayment it is in there in the addition information. You can record it the way it is. Prepayment. The prepayment was 75. That's an asset. For accrual, it's a liability because you've not paid for it. So we had that prepayment. Anything else we've not recorded as an asset? Let us check the debit side. Receivables, we are done with that. Anything else, my friends? Anything else? Nothing, right? I hope we've not forgotten anything. So let us get the total assets then. So we get the total non-current first. Then we get the total asset by adding that plus that. So this one is called total assets, right? Total assets. So the next section is now those assets are financed by equity and liabilities. Equity and liabilities. We begin with equity. So the first equity was, of course, ordinary share capital. We had preference share capital. Or before preference, actually before preference, we have premium, share premium. Share premium. Then we have general reserve. General reserve. Then we have retained earnings. Those are the elements. So let us begin with the first one. In the trial balance, ordinary share total is 15,000. There was no adjustment for that one. The only thing we did was to calculate dividend. So 15,000. Share premium, the third component, it is 2,000. 2,000. Share preference is 2,500. The second item. Debenture will be under liability. Now we have to go to general reserve. Remember, we had general reserve under our adjustment. So general reserve account, general reserve here. Balance carried down, it is 2,500. Then retained earnings. We have retained earnings account. Retained earnings account. Here it is. It is 18,652.5. Right? So we are done with that. Now we go to liabilities. Liabilities. So for liabilities, we have long term like debentures. Debenture. Okay, let me begin by stating that these are none. They are long term. Non-current. Liability. So debenture was the figure for debenture. The only adjustment we did for debenture was to calculate interest. But its value, principal value is 2,500. So after that, I don't think if we have any other non-current. We don't have any other non-current. The rest are non-current. So we write current liabilities. So we have payables. So what was the value for payable? We didn't do adjustment for payable. It is 33.25. 33.25. Remember, we had accruals from the addition information. What was the value for accrual? The way it is, the accrual was 175. Here it is. Accrual is 175. Then we had proposed. Those dividends were proposed. Okay, so proposed preference dividend. Then we also have proposed ordinary dividend. So proposed preference, we calculated proposed dividend. It was somewhere. Here it is. Proposed preference is 250. Ordinary is 1500. So ordinary is 1500. Sorry, not negative. It's supposed to be equal. Yes. What else are we left with? Let's go to the trial balance. Anything we've not used, check for these items. Anything we've not used, there is this item called you can see bank overdraft of 1000. This is not cash. This means they took more money, so it's an overdraft liability. Bank overdraft liability. So bank overdraft of 1000. So if we have recorded everything, then it means it should be okay. I'm hoping so. Let us get the total. So the total supposed to equal the figure we got under total assets. So up to that point, it is 49,402.5. What did we get there? 49,602.5. There is 100 missing. This one is 49,602.5. This one is 49,402. There's a 200. What did we not record? The 200. It's a 200 missing. Let us check. 200. We have not recorded a 200 somewhere, or we've skipped a 200. Who can trace that 200 that we seems we've did we record debenture interest? Yes, debenture interest. We didn't we remember they had said, yeah, we had skipped the debenture interest. If you go to the addition information, they had said the debenture interest was paid first. Remember when I was explaining, I told you that debenture interest, because it does not fall within this accounting period, it means we are going to recognize it as a liability, okay? Because it was paid outside our accounting period. Yeah. So debenture interest of 200, debenture interest. So debenture interest, we had calculated it somewhere and said we are going to record it in the income statement. Let us look for it. Here it is, 200. So that will total. And I hope we had recorded the debenture interest in the income statement, because it's going to appear in both the two accounts. Yes, we had already recognized it here. You can see it is there in the income statement. We had forgotten to record it in the statement of financial position. So this one is total, capital, and liabilities. So with that, my friends, I'm going to give you an assignment to try, but that's how we prepare that. Any question, any comment?